Gold, our savior. Summer market crash, gold coming to the rescue. Well, we shall find out. We have lots to talk about, and I've got a great guest invited on this program today. It's Gary Wagner of the Gold Forecast. Before I switch over to my guest, let me introduce myself real quick. My name is Kai Hoffman. I'm the CEO of the Soar Financial Group, your host, but I'm on Twitter. You can find me at JR Mining Guy as well. Lots of mining talk, lots of commodity talk. Join us over there. Enough of that. Let me introduce my guest. Gary, it's great to see you again. It's been a while. It's been 4 months since we last spoke. It's good to have you back.
Thanks so much for having me. This, of course, is virtual, and last time we at least got to meet in person, which is a great change of pace considering what we've all come through. But good to speak with you again.
As always, Gary, you're in Hawaii. I'm in Frankfurt. You're the only guest I stay up late for, I tell you that. So,
Thank you.
let's make this one count. We got a doozy lined up because we had a chance to chat a little bit beforehand. We got some great topics to cover. But let's start at the beginning. Let's start at the end of January real quick because last we spoke, gold was within like $10 of where we're at today. A lot has happened. Doesn't feel like it, to be honest, in hindsight, but a lot has happened. Do you want to recap it for us real quick?
Well, yes, I mean, considering that it is so close in price to where it was in January, if that was the only snapshot you had, you would go, it's a flat market, when in fact, what we've seen is beginning on November the 3rd, that was the third time gold futures touched a bottom at $1,620. It ran up to within about $5 of the record high. So it ran above 2080. And then, of course, it's been pressured lower recently to take it back down where it is, which is 1950s, 60s area, which is the area you're talking about. So we've seen quite a range. You can say that it's been range bound, but you had a dynamic rally, and we are either at the tail end or in the midst of a corrective period now.
Yeah. What are the major influences on the gold price the last 3-4 months? What would you single out here?
Well, there's really six components. Three of them are interest rates, and interest rates. And the other three are inflation, and inflation. So you've got a huge swath of things that are influencing the market. It's a push-pull between the bearish influence of higher interest rates and the bullish market sentiment or undertones that you create from elevated inflation.
Yeah, okay, that brings me a bit to the present actually, because a week from now, or less than a week from now, we have a FOMC meeting. We'll also get a CPI print just the day before. But what are your expectations? Is Jerome Powell going to keep rates at where they're at? And like I look at the Fed Watch tool, but it seems more volatile than anything I've seen lately.
Considering how much the probability of a rate pause has grown in a week. I think it went from about 38% probability about a little over a week ago to now in the 80s, an 80% probability. The thing that threw everybody off was Powell made a speech in Washington to Federal Reserve members in which he said, I think we've reached sufficient momentum, and it's time, everything being equal, it's time to consider pausing our interest rate hikes. And he said that, and then everybody started to factor in a pause or keeping interest rates between 5 and 5.25%. However, we had the PCE come out recently that actually showed an uptick in inflation. And the key is when you're the Federal Reserve and you've got your foot on the interest rate gas pedal, so to speak, and you're ratcheting 10 consecutive FOMC meetings in a row, and then they get figures out that show that inflation is actually rising, to them it must be a head scratcher. So that brought in the idea, well, maybe they will continue to raise. So that's where that oscillation came between they're going to raise rates, they're going to pause, they're going to raise rates, was that last print of the PCE. I believe that they will pause and they will not raise rates next week. However, I also believe that it's most likely we'll get what is being termed a hop. And a hop is where you implement a interest rate hike pause, and then later on down the road, you raise them again if needed. The key takeaway, though, to me, is that regardless of whether they raise rates after the pause, they're elevated. they're sitting at 5 and above. And when you've got it, there's a real cost to money. And so that is going to have a dramatic impact, not only in the United States, but on global enterprise. And so that's the issue they have to face. But the tools that they're using to bring inflation down is meant to contract the economy. And I think that they've underheated the economy. In other words, they're trying to make it move to a crawl, and that's going to raise a whole other series of problems.
Well, the next meeting is in July 20th, I believe, right around then. But then there's a 8 week sort of gap because FOMC or the Fed breaks for summer. Everybody goes away pretty much.
Right.
What's your like in your thought process? Like how does that fit in? Like I could see them actually hike one more time and then pause in July and then let things play out over the summer, come back in September and see how the dominoes kind of fell.
I mean, obviously, that's who can read the mind of the Federal Reserve. That would be an impossible task to do. But I believe that they will pause. Personally, I think that they will do it more for showmanship and the fact that they had mentioned that they wanted to pause and they want to not so much keep transparent, but have some credibility as what they say is what they do, rather than what they say has nothing to do with what they do. The takeaway to me is that what brought gold from 1620 and had it run to the all-time record high, just shy of it, was optimism that they would make an interest rate cut. Market participants weren't listening or didn't believe the words coming out of Jerome Powell, because he said, listen, we're not going to raise rates. Think about it this way. In December, they came out with one of the most I won't say interesting, but one of the most revealing dot plots that I've ever seen, where that they projected where they were going to be in 23, 24, and 25. And they said that they're not going to have any interest rate cuts in all of 2023, most likely the first and maybe the second quarter of 2024. They're going to keep them elevated. And that was a pretty harsh statement. And yet it wasn't taken in by market participants. It wasn't even taken in by many economists as this is actually what they're going to do. There were a lot of analysts out there going, the Fed can't do that. They can't sustain that kind of elevated interest rate for that long of a period without crashing everything. And we're not even talking about a soft landing or hard landing. We're talking about a deep recession. But yet they've maintained that stance and they've stuck to their guns, so to speak, although these are guns I don't think they should have pulled out personally. But nonetheless, the fact that they are not going to lower rates is huge. And the fact that they're going to keep them elevated and maybe even hike one more time, to me, says that they're extremely serious about reducing inflation to a target that I believe is a fantasy, 2%. That wouldn't have been the case years ago. We had problem with bringing inflation up to 2%. But in this time, with the scenario we faced and what we are facing, realistic, if they got it to 3 and 3.5%, they should say work well done. But if they're adamant about taking it to 2%, they've got a lot of work, because what's happening is that there were immediate components of inflation that just kind of bleeded off. They made the assumption that inflation was transitory when they made their first rate hike in March 2022, and inflation was already over 8%. And it didn't peel off, and certain things did. But once it got to between 4 and 5%, and I'm talking about headline versus core, what happened is there are persistent and sticky components that the Federal Reserve really, they can't control the price of energy. Food costs are something that people still need to eat. So even if they raise the cost, people find other products to move to, but they're still going to spend money on food. They can sure as hell crack the housing market, just bring mortgages from 2% up to 7 or 8%, and people will stop getting new mortgages. But there's certain areas that they haven't had the effect they want to, specifically pay, because the labor market's extremely robust. It's hot. And when you have a robust and a shortage of labor because there's a tremendous need for it, what tends to happen is that's a big component that causes higher inflation. So they're kind of stuck between a rock and a hard place.
Absolutely. Yeah, I saw a number of 10 million open jobs right now in the US, which I think just came out yesterday, I believe. So I don't have an exact source, but I saw that on Twitter being floated around that number, which is really, really high in my opinion. Right. Um,
Absolutely.
so all that you've mentioned, now let's take that together and look at the Treasury bill sales that we're expecting this summer. In June, we're looking at $400 billion Treasury bills that need to be sold, and then in July and September, it's 500 billion, roughly right around 1.3 trillion. Okay, 1.3 trillion. If you just insane number by the end of the year.
Absolutely.
Okay, how does that fit together? Like, if we look at the Fed rate hike policy together with the T bills that need to be issued, and then of course the gold price to make it go around.
Well, I mean, see, that's an extra component that no one really wanted to add to the overall network of things that the Fed had to deal with. But we're going to see a garage sale. The United States is going to open up their bill, bond, and debt instrument garages and have a garage sale, so to speak. They've got to fill the coffers because Yellen has been really paying bills on fumes. She has gone to what she called extraordinary measures. And those measures include taking money from government employees' pension and using it to pay bills. All of those things have to be unwound. And she's got to fill the coffers because the level of money supply pretty much dried up when she hit the debt ceiling, and that happened in January. So from January to now, she's been running on Peter and Paul, pay Peter, pay Paul, and different ways to keep everything running. Now that they raised it by over $1 trillion, she's got to flush that money back into the Treasury, and that's the only way they do it.
Yeah, who's going to be the buyer of those Treasury bills?
Good question. Good question. Right now, the yields are not bad. I mean, if you compare what a yield is today, and even last week you had bills that were maturing in June going for 6%. Now those have come down dramatically, but there is a market for fixed income assets such as government bonds by the United States that are still considered to be at least AA. I don't know if it will affect our credit rating the way it did years ago, but so there should be a decent market for that, but it's a lot to move. That's the whole thing. You're not talking about billions here. You're talking about the big T, $1 trillion plus.
Trillions.
And that's a different story. I mean, the government can always, sell $1 billion here, sell $1 billion there. That's not an issue. But when you've got to replenish coffers that have been sucked out since January, when they hit the debt ceiling and they couldn't really do anything, they couldn't create any more debt because they hit that ceiling. That's a hard ceiling. And so besides the extraordinary measures, they've gone through everything that they could and then some. And now what we're seeing is we're going to have one of the biggest auctions that we've seen in 10, 20, 30 years.
Yeah. I'm not a treasury bond expert, so I'm probably leaning too far out of the window here, even asking the follow-up question, but I'm curious because the 10 years are selling for 3.8 right now, roughly.
Okay.
Looking at the 2 years, 4.5. Do you know what kind of maturity they're being issued at? Like what they're looking at issuing? You mentioned auction. I'm not curious I'm just curious how the whole process works and what kind of maturity bonds they're going to be issuing.
You've got two non-experts in U.S. Treasuries and bonds. So, my sense is they want to have a mix, and that mix because they're paying out less money on the longer term instruments, and the shorter term have gotten way out of whack. That yield curve has kind of really gone haywire. So I think that they're going to sell the shorter term, but they're going to focus on maybe 10-year notes and bonds.
Yeah,
primarily.
Let's move on because let's talk about the effects of it because I'm curious what is happening because in the end I want to know how the gold price is doing over the summer, right? And whether the gold price is going to be our savior. right? In event of a market crash, just imagine they're not selling all of the first $400 billion now here in June, for example, in that auction. Is it going to push up yields higher? Because usually higher yields are not good for the gold price because gold doesn't really pay a dividend. It protects you, it doesn't pay a dividend, right? And it sucks up a lot of cash out of the system, cash that might have been in the safe haven investment gold that gets moved back into a high yield dividend paying or dividend yielding instrument here,
Mhm.
right? So I'm curious what your opinion on that is.
Well, you brought up an excellent point, and that is bullion doesn't yield anything. It doesn't produce, it doesn't work, it doesn't take in any kind of profits, and it pays nothing in the long run. So when you put money into equities, that company now has money to work with, whether they use it to expand, to do mergers and acquisitions, whether they're doing a product launch. That money is going into a system that's providing more jobs. It's making the economy more robust. It's building the GDP of the country. That doesn't happen when you put your money into debt instruments by a government. That sits there, and although it yields something to the investor, it doesn't do anything to the economy. And so it's a very, very eloquent point that you just made. What it does isn't going to have the intended effect of growing the GDP. And that's my concern. My concern is our GDP has gotten so sluggish and been contracted so much by the Federal Reserve implementing such an aggressive stance on interest rates that if this slows it down even more, what is that pushing us towards? Now, in terms of what we're going to look for gold to do, is the key with me on gold is market sentiment more than anything else. Because as we talked about right at the beginning of the interview, there's a push-pull component that's kind of tugging at the apron strings of gold, let's say. And that is that as interest rates go up, it's got a tremendous bearish influence because you got higher yields on whatever instrument it is. But when inflation goes up, then you've got these bullish undertones. So if market participants believe they're going to cut rates or at least keep them where they are, that's at least going to stop the fear factor for gold, and you should get some interest there. But if the equities markets come under pressure, it's going to make gold much more attractive, and that's a whole other story. My sense is, I am a market technician. My technical study said that it should go to 21 to 2,200 between the end of the year and Q1. But the caveat is this market is not really looking at technicals. It's a news-driven event scenario. And as these scenarios play out, that changes the disposition of the market. And so my sense is that we've made that one run just a few weeks ago that stalled at about 2080. But what really amazed me over the last, say, 6 months is that market participants were bidding gold higher under the belief that the Federal Reserve was going to cut rates, when in fact they never said that. They said emphatically the other thing, and that they're data dependent. The last PCE came out showing that inflation is going higher. So it's a quagmire.
Absolutely. Yeah, no, it's like I've said it before in other interviews as well. Like, it reminds me of the song from The Clash, like we fought the law and the law won, right? I keep making that
Yeah,
joke, like it's a bit of a lame one, but it's like we fought the Fed and the Fed won, and I keep coming back to that because in the end, you shouldn't fight the Fed. I think that's the moral of the story, right?
it's a good moral.
Debt ceiling, that issue has been resolved now. And ever since then, last 4 or 5 days, we've seen gold under pressure, right? Are money now investors pulling money out of it? Have investors really been expecting like a US default this month? Is that why gold is now selling off?
I think that the most recent sell-off occurred because inflation ticked higher, which is going to, in the sentiment, the mind of the investor, is going to make them likely to elevate the level they're at for longer or even raise them. That's the key. The key is that when market participants focus on inflationary pressures, gold tends to go up. Right now, they're focused on single-minded focused on what the Fed's doing to interest rates. And as long as they keep raising rates, it will pressure gold to at least be range bound.
Absolutely. No, I believe that. And I've asked a guest previously, do you see like a lower, like a floor? Like the ceiling seems to be 2080. Like we haven't broken through that. But where do you see the floor at? Because if I look at the chart, and I'm not a technical analyst, you were way ahead of me there. But I've seen higher, like it's like a staircase. Like you see the steps being higher and
Yeah.
higher. So where's the next like bottom
I
of the
think
step?
that the hard floor, meaning one level below me right now, I'm on the second floor, but the hard floor is $1,915. That's the hard floor. Now we're at the soft floor because between 1950 and 1960 is an area you'd like to see. And what I'm looking at are the fact that it broke through the 50-day moving average and recently just came back above the 100. It fell below it and came back above it. And so to me, that 100-day moving average fits in with a lot of different things in terms of a Fibonacci retracement of 50% of the full extent of the rally from November all the way to that record high. And so 1915 is absolute support. And then the current area that we're at around 50 is minor support. Minor support. Resistance comes in at $2,000. It's also where the 50-day moving average is.
Gotcha. The miners do need support as well. That's a different story, though. One last question, because I named it summer market crash, gold to the rescue. Do you expect a crash? It seems like we're building a massive momentum to the upside here in general markets. That's just what my gut tells me. Do you agree, or do you see something else breaking?
You mean with the global equities markets or the
global?
US equities?
Mostly global, but of course everybody's focused on the S&P, right? So
yeah, my mentor when I was young and a green pea, which I almost don't think I might not be now after 35 years, always used to tell me it's not a stock market, rather it's a market of stocks. And so when you look at things like NVIDIA that doubled its market cap in one day, went up 28%, and there's certain segments in the AI is really hot, but in technology, there's segments that will continue to produce, and you might get an overall softening of the market, but not in certain sectors of the market. And so that will tend to hold up, keep the overall the index that they're in, like the NASDAQ composite, fairly steady. There absolutely could be, but they've been talking about a market crash for years now, and it hasn't come forth. And so my expertise is definitely not within equities. I watch them every day. I'm acutely aware of them because of how they affect the things that you and I work on, which mining stocks in your case, or mine the price of gold and silver. I am not convinced that the sky is still falling in. But what we have to acknowledge is it easier to do business, to grow your company when you can borrow money for next to nothing or 1% or 2%? Or is it harder when you have to pay 5% for that money? Or if you need to raise money, you're issuing corporate bonds, you've got to have a pretty attractive yield when the government's giving you 4 and 5%. So in that way, there's pressure that hasn't been there. But the other side of the coin is, what was it, 339,000 new jobs added last month? As you said, 10 million 10 million open jobs. It used to be 2 to 1. I don't know what that ratio would be. It's a different climate. And you'll always get people that are going to say, look, the market's going to crash. And every once in a while, they're right. But I think in more occasions than most, they're not. And so I don't want to look at an overall market. Rather, I want to look at what sectors should define going forward and be the strength to those markets to hold up the weaker links. Is it possible? Absolutely. It's harder to do business now with high interest rates. That's a fact.
Absolutely. Yeah, liquidity is another topic, right? The small business owner needs to buy a bag of flour and he needs to take out a loan for it. Like, and bag of flour is a bit of an understatement, but needs to buy a pallet of flour, right? But
Right, right, right.
some of that happens on loan, and if your financing cost goes up through the roof, then of course inflation as well,
Inflation, yeah.
because all of a sudden he's got to charge $3 for a croissant instead of two. So, but enough of that, Gary. This was hugely insightful. Like, this was fantastic. Really, really appreciate your time. And where can we find more of you?
At Gary S. Wagner is my Twitter handle. Our website is thegoldforecast.com, and our YouTube channel is The Gold Forecast. So you can check us out on any of those social media platforms.
Fantastic. We'll make sure to link to them down here below as well. And Gary, I can't wait to have you back on, probably after the summer, sometime September. Love to see you again.
Great to see you again, Guy.
Fantastic. Awesome. Thank you. Thank you very much, everybody, for tuning in. We hope you enjoyed this conversation. Obviously, we chose a bit of a more provocative title, just for some food for thought. Like, what is the market doing? What is gold doing over the summer? Feels like for me, like the summer for gold investors is going to be a bit slower before we look at the fall again. But again, like, it could change in a heartbeat. Like, I open the newspaper every morning looking for that headline, or just open up Reuters.com just for that macro event that's going to happen. Maybe the bond sales don't go so well over the summer. We'll have to see. But who can turn down a 5% 10-year yielding bond, for example, right? So it's tough. So us as gold investors, in my opinion, will have a hard time. But go check out the Gold Forecast. Gary does fantastic work. Really appreciate his time. Really appreciate you guys watching. Hit that like and subscribe button. It's right there. Leave a comment. That helps us tremendously with the algorithm. What do you think of our guest? Who should we bring on the show? What do you think of gold? Let us know in the comments. I really appreciate you guys. Thank you so much for tuning in, and we'll be back with lots more.